Chapter number 1, Financial Literacy. Introduction. In the modern society, financial literacy has a significant role. Every person should be taught financial literacy as a life skill to handle their personal finances. The complexity of financial goods, the prevalence of fraud and Ponzi schemes, the need for money to attain a better quality of life after retirement, etc., are just a few of the problems people deal with. These problems have created a demand for better personal financial management, including proper control of income and expenditure. People who receive financial education become more financially literate and adopt a responsible attitude towards managing their income, expenses, assets, and liabilities, which will ultimately improve their financial well-being. For every household, financial planning is a necessity. Savings alone are not enough for financial planning. It is financial commitment with a goal. Budgeting should be done properly since it is a strategy to conserve and spend money from future income. With the help of this literature, readers can gain a basic understanding of personal finance, including information on financial planning, key financial literacy concepts, different investment opportunities, wealth creation components, insurance and pension products, retirement planning, warnings against Ponzi schemes, tax saving strategies, investor protection measures, do's and don'ts of investing, etc. The student will have a better grasp of and ability to manage their personal finances in order to improve their financial well-being by understanding financial literacy. Definition of financial literacy. Financial literacy is understanding of financial components and skills such as budgeting, investing, borrowing, taxation, and personal financial management. The absence of such skill is referred to as being financially illiterate. Financial literacy makes individuals become self-sufficient so that financial stability can be accomplished. Those who understand finances should be able to answer questions concerning transactions such as whether an item is required, whether it is accessible, and whether it is an asset or a liability. Managing your money is a personal skill that benefits you throughout your life and not that everybody learns. Benefits of financial literacy: ability to make better financial decisions, effective management of money and debt, greater equipped to reach financial goals, reduction of expenses through better regulation, less financial stress and anxiety, increase in ethical decision making when selecting insurance, loans, investment, and using a credit card, effective creation of a structured budget. Key concepts in personal finance. What are savings? The difference between income and expenditure is saving. Income, cash received from a variety of sources including salaries, wages, etc. Expenditure, the amount of money spent on both essential and optional purchases. Most people use their savings to achieve their short-term objectives. Money kept in a bank saving account earns a little amount of interest and is simple to access whenever needed. People can save money in saving account at banks, post offices, etc. What are investments? The act of investing involves putting money from savings into financial or non-financial products with the hope of generating larger returns over time. Investment can be made in a variety of items, including financial ones like fixed rate, bank deposits, stock market purchase, mutual fund investment, etc. Non-financials like the acquisition of real estate, precious metals such as gold and silver. Investments can be made for short, medium, or long-term goals. One should constantly keep in mind when investing that returns on investment may change over time, and that is very natural. What is the importance of saving and investing? When you invest money, it grows for you. Any rise in the investment value over time or investment income or returns that you receive brings you one step closer to achieving your financial objectives. Early in life, one should begin to invest and save. The earlier you get started, the higher your chances are of achieving your objectives, like owning a home, paying for your child's education, saving for retirement, etc. What are assets and liabilities? Your assets are things you own and have economic value, whereas liabilities are things you owe to or have borrowed from others. It is your asset, for instance, if you save and then invest in a fixed deposit. On the other hand, if you borrow money or take out a loan from the bank or another person, you are liable for the loan. What is debt? Money borrowed or meet a shortfall of money when expenses are more than the funds available in hand is called debt. What is the time value of money? As time goes on, you'll learn that if you could afford to buy a whole lunch for a certain amount of money 10 years ago, you could probably afford to buy only a fraction of the meal of the same amount of money today. This indicates that a 500 rupee note would be worth more now than it would be in 5 years. Even if the note is the same, if you have the money now, you can accomplish much more with it because over time you can make it grow by earning interest on it by investing 7,500 you receive now and earning interest or capital growth over time. You can enhance the amount of money you will have in the future. The time value of money proves that time truly is money and at its fundamental level. That is, the value of your money today is different for what it will be tomorrow and vice versa. What is inflation and its effect on investments? Price increases for products and prices are referred to as inflation. The ability of unit of money, such as 1 rupee, to buy goods and services over time decreases as the price of goods and services rises. In other words, the purchasing power of money, or the degree to which it can be used to purchase anything, declines. When making financial plans, it's critical to consider how inflation may affect your investment. Since inflation lowers the value of an investor's investment, investors are extremely afraid of it. How does inflation affect my investment decision? 5 years ago, a vada pav costing rupees 2 would today cost rupees 1. This price increase is due to inflation, which has an effect on the price of the ingredient and ultimately the final product, rather than a high yield or high quality of vada pav. What are the steps that you can take to avoid adverse effects of inflation? Try to calculate your real rate of return, or the return you may anticipate after accounting for inflationary effects. You can invest the money you have now at a rate that is equal to higher than the rate of inflation to lessen the chance that it will lose money. What is the power of compounding? Simple interest simply allows you to earn interest on the principal or the amount you initially invested. Compound interest, however, allows you to earn interest on both the principal and previously earned interest. At the end of each year, the principal amount is adjusted to reflect the addition of the return received during the year to the principal. The return earned on growing principal also reaches years as principal does in the above example. An initial investment of 1,000 becomes 31,409 after 40 years. You earn a return on the return that was already earned when it is reinvested, and so forth. In contrast with simple interest, the principal amount stays at $1,000 for the whole 40-year period. With an annual interest of 90, the amount only increases to 74,600. The rule of 72. According to mathematicians, you can calculate how long it will take to double your money by simply dividing 72 by the interest rate. Let's say that your birthday, your parents gift you a $200 and you intend to invest it. How long will it take for the money to increase to $400 if you deposit in an account that generates 6% interest annually? 72 divided by 6% interest is equal to 12 years. So in 12 years, your money will have doubled to 400. Rupee cost averaging. By using rupee cost averaging, you can invest a set sum of money at regular intervals regardless of market volatility. For instance, you purchase more units at low unit prices and fewer units at high unit prices. By sticking to a timetable, you can avoid the difficulty or perhaps impossible task of attempting to determine the precise optimal time to spend. By averaging out the cost of your units, the rupee cost averaging effect decreases the influence of short-term market swings on your investments. Why to keep money in banks? The following are drawbacks of storing cash at home. Loss of growth opportunities, loss of interest income. Unsafe money can be stolen or lost due to natural calamities. No low credit eligibility. Deposits in bank create eligibility for borrowing. As a result, it is advantageous to hold cash in banks rather than at home. Banking. Since commercial banks deal with public funds and trusts, they are regulated financial institutions. The Reserve Bank of India oversees commercial banks in India. At regular times, banks undergo mandated audits and inspections. The Reserve Bank of India also conducts an annual audit of banks. Investments with a reduced risk profile include bank savings depending on the demands of the clients. Banks offer a variety of deposits. The liquidity and the safety of bank deposits are valued more than the returns they offer. Additionally, fixed deposit loans from banks are available up to 75 to 90% of the deposits value. All deposits are covered by the government under the central government deposit insurance scheme up to a maximum of 5 lakhs per client in that specific bank. Deposits are therefore promised that even in the event of a bank failure, the government will intervene and recover up to 75 lakhs of their funds in the bank. One may occasionally go to the Reserve Bank of India website for detailed details on the scheme. Know your client. Norms for the account opening process. Customers must go through the KYC process in order to open any form of bank account. KYC is an acronym for Know Your Customer. The goal of KYC is to help banks better know and understand their customers and assist them in managing their risk responsibly. The KYC documents that banks typically accept include a photo or document of evidence of identification, such as a copy of PAN card or an Aadhaar card, and a document for address verification. Types of bank accounts. First, saving bank account. Low interest, however highly liquid, facilitates payment mechanism through automated teller machines. No tax deducted at source on interest on SB account balance, but taxable in the hands of depositor. Account can be opened in single name or joint names. In the case of joint account, the operation of the account can be done by any one account holder or jointly. Minors of any age can also open a saving bank account through the natural or legally appointed guardian. Minors above age of 10 years can also avail additional banking facilities like internet banking, ATM, debit card, checkbook facility, etc. Basic savings bank account deposit introduced to promote financial inclusion. Zero balance saving account without any requirement of initial deposit can be opened for individuals and also minors. ATM cards, passbooks are issued free of charge. BSDBA account holders are not eligible for opening any other saving bank deposit account in that bank. Third, fixed deposit account involves placing funds with the bank for a fixed term or at a certain interest rate. Senior citizen may get extra benefits on the interest rate. Tenure and the rate of interest on FDs varies from bank to bank. Recurring deposit account. A fixed amount is deposited at monthly intervals for a predetermined term, earns higher interest than saving banks account. TDS applicable on interest accrued or earned beyond a stipulated amount. Senior citizens may get extra benefits on the interest rate. Tenure and rate of interest on RDs varies from bank to bank. Fifth, special bank term deposit scheme, tax saving scheme available with banks. Relief under Section 80C of the Income Tax Act 1961. Term deposit with 5 years lock-in period. No premature withdrawal or loan allowed. Digital banking. In the modern era, transactions include payments, fund transfers and buying goods all take place on the digital platforms such as mobile phones. Customers can perform transactions from any place. The various digital modes of transferring funds are as follows. NEFT, National Electronic Fund Transfer, transfer of funds from one bank account to another. No restriction on the minimum or maximum amount for transfer. Transfer is done using beneficiaries or account number and IFSC code. Charges for transfer may differ from bank to bank. Transfer of funds can be initiated anytime during the day, and it takes few hours to get credited in the beneficiary account. RTGS, real-time gross settlement. Transfer of funds from one bank account to a different account of another bank on a real-time basis, used to make high-value transactions. Transfer is done using beneficiary's account number and IFSC code. Charges for transfer may differ from bank to bank. Transfer of funds can be initiated during a specific period on working day and is completed instantly on a real-time basis. IMPS, Immediate Payment Service, transfer of funds from one bank account to another, facilitating instant fund transfer. For fund transfer through internet banking, beneficiary's account number and IFSC code. For fund transfer through mobile banking, beneficiary's MMID, mobile money identifier, is a 7-digit number issued by bank to the customer is needed. Unified Payment Interface, UPI, instant transfer of funds through any smartphone using VPA, virtual payment address. 24/7 fund transfer facility on real-time basis. One needs to download UPI enabled bank app and log in using bank details. New categories of banks and business correspondents. Payment bank. Key features: provide savings account, current account facilities, can accept demand deposit but not recurring or fixed deposit, can issue ATM or debit cards but not credit cards, cannot give loans or advances, offer payment and remittance service through various channels. Small finance bank. Provide features like taking small deposits and disturbing small amount loans. Instrument to save funds primarily unserved and undeserved sections of population. Extend loans of small amount to small business units, micro and small enterprises, small and marginal farmers, and entities in the unorganized sectors. Business correspondent. Representative of a bank who goes to customers, usually in remote locations or villages, to help them with their banking needs or transactions. Can provide services like opening of bank accounts, deposit, transfer of funds, collection of loan deposit, disposal of small value credit, collection of payment fees, etc. What is a credit card and a debit card? With a credit card, the card holder can make payments without having a cash on hand right away by using credit card transaction. The benefit of using credit for a limited time. A debit card, on the other hand, is a card issued to a bank account holder for both making payments at points of sale and withdrawing money from an ATM. Debit card are accepted for transaction settlement at all retail locations. Both credit and debit cards can be used for online purchases as well as cash withdrawals from ATMs. Particular source of fund. Credit card lending bank provide the credit facility. Debit card linked in one's own savings or current account maintained with the same bank. Interest in the credit card is outstanding amount. If not paid on time, interest is levied. In debit card, there is no interest. Credit history is not relevant for issuing a credit card, and for a debit card, the issuance is not relevant. Relationship with the issuer. No compulsion to have account with the issuing bank in the credit card, and having an account with the issuing bank is a prerequisite for a debit card. Things to keep in mind while transacting through ATM card: immediately after receiving the card from the bank, change the PIN. Avoid making any notes of your PIN number. Recall it. Keep your PIN number a secret from others. It is preferable to use an ATM on bank property or on property where a security guard is on duty around the clock. Use it for yourself. Change your PIN as often as practical. Notify the bank right away if the card is missing. Don't let anyone use or access your card. Sign up with your bank to receive SMS notifications of transactions. Banks, however, have the right to charge clients for sending them email or SMS warnings about their accounts. Now, customer liability for unauthorized banking transactions. According to RBI, if an unlawful transaction occurs because of fraud, contributory carelessness, or a failing on the part of the bank, the consumer is not responsible. In a similar vein, even in cases where neither the customer nor the bank is at fault, but instead another component of the system is at fault, the customer is exempt from liability as long as they notify the bank of any unauthorized or illegal activity within 3 days of receiving a notice from the bank. Additionally, the bank must immediately credit the customer's account with the sum involved in the transaction. However, in situation when such fraud occurs due to the negligence of the client, the customer will be responsible for paying all losses up until the date that the unlawful transaction is reported. The RBI has made it clear to banks that they must instantly notify consumers via SMS and email when a transaction occurs on their account. In order for a customer to report any such fraud right away, they have been told to make sure that such messages can also convey the client's reply. Now, Reserve Bank of India, RBI. The Reserve Bank of India Act authorized the establishment of the Reserve Bank of India, the National Central Bank, on April 1st, 1935. The Reserve Bank of India is responsible for overseeing the nation's monetary and credit systems and implements monetary policy to establish financial stability in India. The primary objective of the RBI is to perform comprehensive supervision of the Indian financial sector, which consists of commercial banks, financial institutions, and non-banking financial firms. It develops, enacts, and oversees India's monetary policy, maintaining price stability and ensuring that credit is flowing to productive economic sectors are the central bank's management goals. The RBI governs and regulates the entire banking system in addition to serving as the government of India's banker. All commercial banks' lender of last resort is the RBI. Chapter number 3, Savings and Management of Spending. Introduction. Money plays an important role in our lives. On one side, it is a tool for wealth creation for future needs, and on the other, it serves as a transaction instrument for satisfying present needs. While many people spend most of their time and energy on earning more, it is important to know that without learning the art of spending money, well, along with judicious saving and prudent investing, they may not be able to create a promising future for themselves and their families. It may be observed that learning to manage money wisely could be the first step towards the bigger goal of financial planning. In this chapter, we study about the savings, its benefits, management of spending, and financial discipline. Savings. Savings refer to money you put aside for future use rather than spending it immediately. Savings is the portion of income not spent on current expenditure, because a person does not know what will happen in the future. Money should be saved to pay for unexpected events or emergencies. An individual's car may break down or a medical emergency could occur. In economics, savings is the amount that is left after spending. In banking, saving refers to saving accounts which are short-term interest-bearing deposits with a bank or other financial institution. So we can say that saving is the money you want to be able to access quickly with little or no risk, and with money in the bank, while for others it means buying stock or contributing to a pension plan. But for economists, saving money only one thing: consuming less in the present in order to consume more in the future. Why should we save? First, emergency fund. One of the most important things to save for is an unexpected financial emergencies. These can include losing your job, unexpected health issues, or your car or other home appliance breaking down. So you should have between 3 and 6 months worth of living expenses set aside. Education. The cost for private and public education are rising every year, and it's getting tougher to meet these demands. As students take on more debt, their financial burden rises. Aggressive saving is the easiest way to minimize debt. Major life events, getting married, traveling the world, purchasing a home, having a child, none of these come cheap. Saving for such milestones help reduce their inherent stresses and allows you to focus on what really matters. Average life expectancy. As we age, our ability to work and earn more money to support our lifestyle will naturally decrease, and with today's healthcare and technology advancement, life expectancy has increased, which requires more funds to live. Surely, saving now will assist you when the work advancements are no longer realistic. Retirement. Another important reason to save your money is retirement. The pension scheme is unlikely to provide you with enough income to cover all your costs when you eventually stop work, particularly as the age at which you will be able to claim it is moving gradually further away. The sooner you start saving for retirement, the less you will have to save in the future. Financial security. Suddenly finding yourself unemployment can be frightening, but it's something many people will experience at some time. Having a saving buffer in place to help cover your living expense while you find a new job can provide you with real peace of mind. Now, 3.4, how to save. We can save either by cutting expenses or by increasing our income. Presuming income is same, we spend money for purchasing either essential or non-essential items. Essential items are those things we really cannot do without, such as good clothing, house repairs, seeds and farming tools, children's education and healthcare. We need these things every day for survival, whereas non-essential items are extras in life which we need because we enjoy them. Expenses on such items can be either avoided or reduced or postponed. How can we save when we do not have enough money even to meet our regular expenses? The common refrain is that we do not earn enough, so we cannot save. The truth is that everyone needs saving and can save. We should keep aside a portion of our earnings as saving from day one of our earning life. The important thing is that we should start saving early and regularly in our life. Even if it is a small amount, even if we get some unexpected profit or earning, we should save all or most of it. This will reduce our worries for future financial needs and help us in dealing with unexpected expenses. Where to save? You can save at least a little every month. What would you do with your savings to keep them safe? There are many options. It can be as simple as saving accounts at a bank. It can be recurring or fixed deposit or post office savings scheme. Saving accounts. Saving accounts are handy for short-term savings. You can deposit money into saving account at any bank. This will help this will keep your savings safe and pay a little interest. You can take your money out whenever you need it. Recurring deposits. Recurring deposits, popularly known as RD, are best if you wish to create a fund for a special occasion such as buying a car. These are suitable for people who do not have a large amount of saving but are ready to have a small amount every month. No withdrawals are allowed. Fixed deposit, commonly known as FD, this is where you can deposit a sum for a fixed period. The depositor is given a fixed deposit receipt which the depositor has to produce at the time of maturity. Withdrawals are not allowed. However, in case of need, the depositor can ask for the fixed deposit account to be closed by paying a penalty. Each type of saving vehicle has cost and limitations. Check them carefully to be sure you understand the terms and whether they provide what you need. Management of spending. How we manage our spending also affects our saving habits. The best to manage spending is to have money automatically drawn from bank account to fund those things that are necessities or are most important. If you did not put savings on autopilot, it would not get done, at least not as easily and consistently as it could be done. Consistency and simplicity are the key when it comes to achieving financial success. There's no time like the present when it comes to learning how to manage money better. Managing spending and keeping up with your budget can be a difficult task, but there are ways to make it easier and manage your spending, reach your financial goals and improve your financial well-being. Steps followed for managing the spending. Step 1. Take inventory of your finances. Before you start managing your money better, you need to know how much of it you have. The most basic step to understand your current financial situation is to sit down and record all your regular monthly income and expenses. If needing, save receipts for a month to determine where money is spent beyond major bills like rent, utilities and debt payments. For some people, it can be a wake-up call to realize how much is being spent on items such as groceries or dining out. Take a mental inventory of your current position. Are you constantly overspending? Do you have enough saved up to survive an unexpected expense? Do you have live paycheck to paycheck? Do you have more control over day-to-day, month-to-month finances? Do you have a greater cushion to absorb a financial shock? Are you getting on track to meet your financial goals? Do you want to have more financial freedom to make the choices that allow you to enjoy your life? Step 2. Build a money management blueprint. Start with a budget. Pick a budgeting system that you will stick with. We like the 50-30-20 budget plan, which allocates money for wants, need and saving and debt repayment. But there are plenty of other budgeting options to choose from. Track your spending. The days of balancing a checkbook are gone for most people, but there is still value in accounting for each and every purchase and expense. Find ways to save. Once you see where your money is going, you can more easily identify potential saving. Use designated account for spending and saving. Keep money designated for bills and budgeted expenses separate from your emergency fund. This will reduce the temptation to dip into it for non-emergencies. Make a plan to pay off debt. A strategic approach to debt repayment will help you reach the debt-free finish line faster. We recommend tackling your most expensive debt, the accounts with a higher interest rate first, while maximum payments are in the rest. Then work your way down to the lower interest rate debt until it is all paid off. Develop good credit habits. Credit cards can be your friend if used wisely. You can earn cashback and travel rewards on things you already plan to purchase and boost your credit score in the process. The key is to pay off your balance in full each month. If your credit utilization, the percentage of your credit limit used hits 30%, your credit score will take a hit. Interest in your financial future. Set money aside now for retirement plan and let compound interest work its magic. The ultimate goal is long-term financial freedom and stability. Step 3. Make savings a habit. Money mastery goes beyond spending less than you make. A true sign of financial prowess is saving enough to live comfortably in the long term as well as the short term. You can achieve this in 4 steps. Save, invest, pay off debt, repeat. Save. Start stocking away extra money to build an emergency fund. Ideally, you should have 3 months worth of living expenses at your disposal in the case unthinkable happens. If that seems too ambitious, start small. Invest. Invest your extra money for the future. Set yourself up for retirement by contributing to a retirement plan. If your company offers a pension benefit, contribute enough to get maximum. Third, pay off debt. Whether it's a loan or looming credit card bill, you probably have some debt obligations. Always take at least the minimum monthly payments so you don't fall behind. If you have extra bills to throw at your bills, pay down the high interest debt first. Repeat. Keep building up that emergency fund, investing for retirement and knocking down your debt. Step 4. Be persistent. Despite their good intentions, many people fall off the financial bandwagon. Sticking to a budget that's too restrictive can be suffocating. Navigating investment jargon can be confusing, but don't get discouraged. Managing finances requires an ongoing effort. To be successful, revisit your budget often and try to analyze it. Compare your actual spending to your budget at least monthly or more frequently if possible. Make adjustments to your budget if it is habitually out of line with the actual speaking. Check your balances regularly on the accounts, credit cards, and prepaid cards. You can check your balances online at an ATM on your smartphone or by calling your bank. Be aware that these services may incur fees. Check first with your financial service provider. With hard work and dedication, you can manage your money with confidence. 3.8. Financial discipline. Financial discipline refers to how well you're able to conform your spending and saving to the plans that you have set for yourself. It is a continuous process and involves as your priorities change over time. It is also based on understanding that money is just a tool and that you control your money. Money should not control you. Financial discipline means being in control of your money. You are able to avoid impulse spending and less likely to blow off your money before paying your bills. If you have financial discipline, you will save for an item and can set aside sinking funds without spending the money on something else. Do you have financial discipline? If you are asking this question, it may be a sign that you need to evaluate your money situation. If you answer yes to all the 6 questions, you definitely are on the right track. Do you pay your bills on time? Do you have money in savings? Are you saving for retirement? Do you have an emergency fund? Do you use sinking funds to help save for large items on holidays? Do you live below your means and practice frugal living? Answering yes to this question is a sign you have financial discipline. How to be disciplined with money? Education. Educating yourself on financial discipline is the key to overcoming obstacles and learning to be successful with your money. Habits. Start small with saving goals and continue to grow. Small habits turn into big habits and eventually they are life-changing habits. Accountability. Hold yourself accountable. Write down your goals and check in every 2 weeks. Furthermore, you can also find an accountability partner that has similar financial goals. 3.9. Smart tips to inculcate habit of financial discipline. Prepare a monthly spending budget and stick to it. Invest with a goal. Goals give direction and help you in selecting right product. Avoid loans for your desire. Better do a financial planning check before going in for a big purchase. Invest monthly to become regularized in your savings, and this will also help you maintain consistency. Motivate yourself by visualizing the goals and the end result for which you're working for. Pamper yourself. Give yourself a party or a vacation or whatever you feel like when you achieve your spending target. Penalize yourself if you stop your investment before target date or spend more than what you have budgeted for. Your penalty cannot be having any dine out in that particular month. Be accountable to someone. Both spouses can keep a check on each other on spending habits. Take help of financial planner wherever you require. This can be a good source of support. Take review of the situations after a set period. If your credit cards are bothering you and coming in the way of being disciplined, get rid of them. Chapter number 2, Income, Expenses and Budgeting. Introduction. Are you sometimes short of cash at the end of the month? Don't seem to be able to save for the things you really want? You can learn to balance your income with your expenses and even have some money left over for savings and extra. Let us show you how to manage your incoming and outgoing finances. Setting priorities, needs and wants. Need. A necessity, something required, something essential for life. A need is something thought to be a necessity or essential item required for life. Example include food, water and shelter. Want. A desire, something wished for, something non-essential but desired, or items which increase the quality of life. Example include a car, CD, a designer clothes, and depending upon what a person defines as a need or a want will influence his or her financial decisions. For example, a person who deems a vehicle as a need will have larger expenses than a person who relies on a bicycle for transportation and sees a vehicle as a want. Using these definitions, a roof over my head is a need. So clothing, food, tools of work and medication, watching movies in a theater is a want, and so a reduction like chewing pan, smoking and drinking. Income. Income is what is earned or received in a given period. There are various terms for income because there are various ways of earning income. Income from employment or self-employment is wages or salary, deposit account like saving account, on interest, which could also come from lending, owing stock entitled to shareholder to a dividend if there is one, owing a piece of partnership or a privately held corporation entitles one to a draw. Most of us have a source of income through our job, business, farming or other work. Many also be receiving interest income from their investment. Whatever the sources of income, you need to know how to keep track of it and manage it to cover your expenses and save for the future. Expenses. Expenses are cost for items or resources that are used up or consumed in the course of daily living. Expenses recur, that is, they happen over and over again because food, housing, clothing, energy and so on are used up on a daily basis. You will usually have two categories of expenses in your budget. First, you will have your regular monthly expenses. These are expenses you know you will have each month. Second, you will have your irregular expenses. These that come up every now and then and are perhaps once a year. For example, you may have an annual car insurance bill you will need to pay, or a club membership, or a new cell phone you know you are going to need soon. You will want to plan for such expenses in your budget and allocate some funds each month so that you can pay for them when they are due. It costs money to live. You need to pay for food, clothing, housing, transportation, communication and a dozen other unnecessary and necessary expenses. Then there are things like vacations, entertainment, children's education and marriages, gift for a relative and so on. Track your expenses. The best way to start taking control of money is to track your expenses, and that is not hard today with how easy it is to carry a little notebook, to use a notepad on a cell phone or other handheld device. All that you have to do is over a month or 2 or 3 write down that what you spent on 500 movie, 100 scarf, 500 book, 300 bus pass and so on. Then take a few minutes at the end of that time and write down a number of categories. These might include transportation, school supplies, snacks, eating out and food in general, movies, music and entertainment, your hobbies, cell phone and internet, saving and so on. Next, before you add up how much you have spent on each category, write down the percentage of your money you think you spend on each category. Then add up how much money you actually spent on each category. See if the results surprise you, or see if the results come closer to what you expected. This will give you one sign as to whether you know where your money is going, and if you're in control. There's one thing you can do too. Look at how much you're spending in each category. Is that the way you want to be using your money? Are you spending more in some areas that you would like to or think you should? Are you saving as much as you would like or need to? Going through this exercise, seeing wherever your money is going and thinking about where you want it to go should tell you pretty clearly if you need to budget. If you're pleased with how things are and happy with how you're using your money, you may need a budget, at least not yet. It may be that you are in control of your money and managing it well. However, as you make more money, take on new expenses and life becomes more complicated, you might find that having a budget will help you stay in control. Emergencies. Unexpected necessary expenses that could happen anytime, illness, injury, transportation, etc. This could significantly affect a month's budget. Limiting the discretionary and variable expenses as well as savings. Emergencies are by nature often costly and therefore demonstrates the importance of having a regular contribution to savings. Having savings prevents or limits you from getting into debt to pay for an emergency expense. Budgeting. As a budget is a plan for how you use your money on a month-to-month basis. It helps you look at your expenses, both those you have each month and those that come up now and then. It helps you work out how you will cover your expenses from your income. Budget also helps you to save, build up your savings over time and achieve your financial goals. A budget helps you to know where your money is going. As you work out your budget, you may find ways to cut back or ways to save more. If you can use your budget to pay yourself first, if you pay yourself last, it often ends up that there's nothing left. Put some of your money in savings when you get it and budget how you will use the rest. Even if it is a small amount, try and start by paying yourself with savings and try to make saving a habit from a young age. It is a great habit to develop. It can be an important way to achieve your goals. Basically, a budget involves comparing your income with your expenses. It gives you a picture of your financial situation, where you may be heading, and it should give you a very clear indication of whether or not you are on the road to accomplish your long-term goals or not. Many people don't budget because they feel that they don't earn enough money to need a budget. In reality, the less money you have, the more likely it is the budget can help you. You will want to get the most out of your money, and you wouldn't want to waste any. You will want to make as many good money decisions as you can. Budgeting can help most people regardless of how much money they have. There are also many people who don't budget because they feel that a budget will put them in a financial straitjacket. They think a budget will have too much control over what they do. Actually, a person who fears that a budget will control them too much is often a person whose spending is out of control. If you fear a budget, you probably need to budget. A budget helps you gain control, not lose it. Deciding a budget is a sure sign that you have decided to take control of your money, but have you any idea how your money is being used, where it is going? It is simply a comparison of income and expenses. It is the difference between your total income and total expenses, a positive or a negative figure. If it is positive, you have a surplus. Congratulations, with the extra money you must pay off any debt or loan you have. Otherwise, you can increase your monthly saving and invest for future. If it is a negative, you have a deficit. You need to make changes to balance your budget, reduce your expenses by focusing on your needs rather than your wants. This can be okay in the short term, but it is not sustainable in the long terms. Most often, it is done that a monthly interval at this provides a consistent yet accurate description of actual income in comparison to expenses. Income can either be in form of regular paycheck or spontaneous sources such as gift or sales. Regular expenses are also best understood as a monthly basis, as this helps you to stay in line with your budget. The first thing to work out is your monthly income. That will tell you what you have got to work with. The second step is to list your monthly expenses. Some expenses you will be able to control, others you can't control as readily. You can always take more control of a cost like rent by moving to less expensive accommodation or getting a roommate to help share the cost, but that will take some time. When you add up your total monthly income and your total monthly expenses, you will see whether you are able to save money or not. You will find if you are spending more than you would like to in certain areas, you will quickly see if you are in control of your money or heading toward money problems. In short, you can learn a great deal about you and your money by creating and using a budget. Chapter number 4, Time Value of Money. Introduction. The time value of money is a basic financial concept that holds that money in the present is worth more than the same sum of money to be received in the future. This is true because money that you have right now can be invested and earn a return, thus creating a larger amount of money in the future. Also, with the future money, there is additional risk that the money may never actually be received for one reason or another. The time value of money concept helps in arriving at the comparable value of the different points of time with equivalent values at a particular point of time, present or future. There are two ways by which the cash flows arising at different points of the time can be made comparable. First, by compounding the present money to a future date, and second, by discounting the future money receipts to present date. In financial decision making, interest and funds play a very crucial role. The TVM concept explains as to why the interest is paid on money borrowed. The time value of money can work for you or against you. For example, if you're deciding between buying a new phone for 50,000 or invest in a stock, for example, that yields 10% per year, if you buy the phone, you have just incurred an opportunity cost of 10%. In this chapter, if we discuss about the time value of money techniques and its application in our real life. How the time value of money works. A simple example can be used to show the time value of money. Assume that someone offers to pay you one of two ways for some work you're doing for them. They will either pay you 1,000 now or 1,100 1 year from now on. Which pay option should you take? It depends on what kind of investment return you can earn on that money of that present time. Since 1,100 is 110% of 1,000, then you can believe you can make more than a 10% return on the money by investing it over the next year. You should opt to take that 1,000 now. On the other hand, if you don't think you could earn more than 9% in the next year by investing the money, then you can take the future payment of 1,000 and 100 rupees as long as you trust the person to pay you then. Reason for the time value of money. First, inflation. Because if inflation is safe to consider, that amount of money can get us more services and goods than it can in the future. You have chosen the first option in the previous example because you understand that 1 lakh can get you more things today that it will give you a year later. Second, risk involved. What if in the previous example you choose to receive a money a year later, but then when you approach the person, they say they don't give the money to you. This could also happen that if you lend money to someone but they go bankrupt before they can repay you. This shows that there is a certain level of risk involved if you choose to get your money at a later date. Third, preference for current consumption. In this example, you choose a present consumption to future consumption. In general, people always want to have preference for current consumption. They find it more satisfying to use money for their present needs of buying food, clothing, shelter, etc. rather than deferring them to the future. Fourth, investment opportunities. If you receive the money today, you will invest that money to get higher values to be received tomorrow or after a certain period of time, though return from the investment at least in the form of interest. With these 4 reasons, we can justify the existence of the concept of the time value of money. Importance of time value of money. The time value of money, TVM, is a useful tool in helping you understand the worth of money in relation to time. It is a formula often used by investors to better understand the value of money as it compares to its value in the future. Below, we will go over in and out of the TVM and how you can use it to understand the effect time has on the value of your money. Components of time value of money. First, interest or discount rate. It's the rate of discounting or compounding that we apply to an amount of money to calculate the present or future value. Second, time period, N. It refers to the whole number of time periods for which we want to calculate the present or future value of a sum. Thus, time periods can be annually, semi-annually, quarterly, monthly, weekly, etc. Present value, PV. The present value is known for the current value of a sum of money that we will receive in the future, the amount of money that will obtain by applying a discounting rate on the future value of any cash flow. Future value, FV. The future value is known as the future value of a sum of money that we invested today. Fifth, installments, annuity, PMT. Installments represent payments to be paid periodically or received during each period. The value is positive when payments have been received and becomes negative when payments are made. 4.6, techniques of time value of money. Compounding. It is a process of computing the future value of an investment made today or series of investment made over a period of time. The process of investing money as well as reinvesting the interest earned thereon is called compounding. The future value or compounded value of an investment after n years when the interest rate is FV is equal to PV 1 plus R to the whole to the power of n, where FV is future value, PV is present value, R is interest rate, and n is time. In this equation, 1 plus R to the whole square of n is called the future value interest factor or simply the future value factor. We can calculate the value directly or we can use the compounded value factor table to find out the values. The calculation is useful for investors and businesses who want to know the future value of their potential investment to make a good investment decision. This formula requires only 3 things to give a future value. What amount of value do we have right now? What is the assumed interest rate at which it will grow? And after how many years will we need the money? Non-annual compounding. The effect of compounding if done more than once a year can be expressed by using the formula. F1 is equal to PV into 1 plus R divided by M whole to the power of n into M, where M is the number of times per year compounding is made. In semi-annual compounding, M is equal to 2. In quarterly compounding, M is equal to 4. In monthly compounding, M is equal to 12. Effective rate of interest. Effective rate of interest is the interest rate that is actually earned or paid annually. In the case of non-annual compounding, it is calculated as E is equal to 1 minus Rm to the power of M minus 1, where E is equal to effective rate of interest 1 minus R divided by M to the power of M shows future value of 1 rupees after 1 year. Future value for series of cash flow. When different amount of cash flows occur in various years for a series of years, the future values of unequal cash flow can be easily calculated on the basis of compound interest. Future value of annuity. An annuity is the stream of equal cash flows, payment or receipt, occurring at regular interval of time. The premium for the life insurance policy, for example, are an annuity. When the cash flows occur at the end of each period, the annuity is called an ordinary annuity or a deferred annuity. When the cash flow occurs at the beginning of the year, it is known as annuity due. Future value of an annuity due. When the cash flows occur at the beginning of each period, the value of such annuity is called annuity due, and its future value FV can be calculated as under FV annuity due is equal to annuity amount into CVAF into 1 plus R. Power of compounding. Mathematically speaking, compounding is defined as the increase in the value of an investment due to the invest on the principal as well as the accumulated interest. Simply put, it is a strategy that makes your money work for you. It could be regarded as a powerful tool to grow your wealth. You can use the power of compounding to plan your future goals such as retirement. Simple interest means you earn interest on your principal, but with compound interest, you earn interest on the principal amount as well as accumulated interest amount over successive periods. Over time, this interest snowballs into a substantial amount. Here is a hypothetical example to highlight the power of compounding. Ram and Shyam both invest 1 lakh each in an investment avenue that offers an annual interest rate of 10% for 10 years. While Ram chooses compound interest, Shyam opts for simple interest. At the end of 10 years, Ram would make a total corpus of 2,59,374. On the other hand, Shyam would earn a corpus of 2 lakh. This is because in Shyam's case, the interest was calculated only on the initial principal amount of 50,000. But in Ram's case, the interest earned each year was included along with the principal to calculate the interest rate for the next year. This helped increase her earnings in a big way. One of the biggest benefits that investor can appreciate about the power of compounding is the value of time. With time, you could gain returns, and the yields of these returns could further generate returns, thus helping to increase your investments quickly. The power of compounding works by growing your wealth exponentially. It adds the profit earned back to the principal amount and then reinvests the entire sum to accelerate the profit earning process. You don't need to be a financial expert to benefit from the power of compounding. Every investor can take advantage of this concept and put it to good use. So start investing today to enjoy a great future. 4.7 Discounting. It helps in determining the present value of a sum of money or a series of payment to be received in future. This process is in fact the reverse of compounding technique and is known as discounting techniques. In order to evaluate the present value of any amount, the same formula which was used for compounding purpose is used but in an inverse manner. Present value of a single amount minus from compounding, we know that FV is equal to PV into 1 plus R to the power of n. Thus, to find out PV is equal to F1 divided by 1 plus R is equal to FV into 1 plus 1 divided by 1 plus R to the power of n. Like compound interest table, present value tables are also available for different discount rates and years. Present value of a series of unequal cash flow. In financial analysis, we can often come across uneven cash flow streams. For example, the cash flow stream associated with the capital investment projects is typically uneven. Likewise, the dividend stream associated with an equity share is equally uneven and perhaps growing. In this case, we will find out the present values of each individual payment as per table and then adding these present values. Second, present value of infinite life annuity, perpetuity. An annuity that goes on forever is called perpetuity. The present value for perpetuity of cash flow is given by formula PV is equal to annual cash flow divided by interest rate or discount rate. Present value of a series of equal future cash flow or annuity. In order to find out the series of equal cash flow, the PVs of different times are to be calculated and then added. Present value of equal flows may be calculated on the basis of present value annuity. Option 1, since 1000 receivable, now it is already expressed in present values and hence needs no adjustment. Option 2, since the interest rate is 12% per annum and the annuity cost of 12 periods, the rate of interest per period may be expressed as 1% on the basis of the present value may be calculated as follows. PV is equal to annuity amount into PVAF is equal to 1000 into PVAF is equal to 1000 into 11.255 is equal to 11,255. Since the present value in option 2 is higher than present value in option 1, the student should choose option 2. Present value of an annuity due or annuity due at the beginning of each year. Example, Mr. A has to receive 20,000 at the beginning of each year for 5 years. Calculate the present value of annuity due assuming 10% per annum interest. Solution, PV is equal to annuity amount into PVAF into 1 plus R to 20,000 into 3.791 into 1.10 is equal to 83,402. Some application of time value techniques. Determination of interest rate or growth rate. Sometimes various schemes are offered by the financial companies under which a person is required to deposit a specific sum in the beginning of a period, and then return is available to him in form of annuity for a certain number of years. The investor would like to calculate the rate of interest available to him in case of such scheme, for which the following formula can be used. PV is equal to annuity into PVAF. Determination of growth rates. The time value of technique can also be used to find out the growth rates and revenues, cost or profits of a business firm. The compounded growth rate can be calculated as follows, where the FV is equal to PV into 1 plus G to the power of N, and G is equal to FV divided by PV to the power of 1 divided by N minus 1, where G is the growth rate. Determination of number of years. Time value of money concept can be used to find out the number of periods needed to grow a certain present amount to a specified future value at a given rate of interest. Sometimes an investor may be interested to know in how many years his value will be doubled or tripled or will grow to a certain amount for a given rate of interest. The compound interest tables can provide quick answer in such case. Calculation of deferred payments. Deferred payments means a payment that are started after a certain number of years. In many cases, we find a borrower taking a loan which is not interested in starting the repayment immediately after a year. In such cases, the interest on loan would get accumulated for those initial years for which the payment is deferred. As a result, the payment installment will be calculated for a sum obtained after combining the loan and the accumulated interest amount. Both technique of compounding and discounting are required to be used to calculate the repayment installment amount. Sinking fund problem. Sometimes a financial manager is faced with a decision to collect a specified sum on the periodical basis at a specified rate to reach at a prescribed target amount, or in normal life we would also face with similar situation. For example, if you target to go to Europe trip after 5 years, and for this you need 10 lakh amount. Now the question arises that if a compound rate of 10% is available, then what amount shall be allocated or provisioned every year so that at the end of 5 years you would have 10 lakh available with you. This can be worked out using the formula given below. Future value is equal to annuity amount into CVAF. Annuity amount is equal to future value divided by CVAF. In this case, in this example, annuity amount is 10 lakh divided by CVAF 10% and 5 years. So it is equal to 10 lakh divided by 6.105, and the answer is 1,63,800 rupees. So we have to deposit 1,63,800 rupees to make it 10 lakh after 5 years. Amortization of loan or capital recovery. When we take home loan, car loan, or any other type of loan from any bank, it may be required to pay the same in form of specified periodical installments. In order to determine the amount of installment of the loan, we can use the under mentioned formula provided the rate of lending is given to us. Example: Sanjana borrowed loan of 5 lakh, which is to be repaid in form of a 5 equal installment. Now, if the compounding rate is 12%, the amount of such installment would be given as PV is equal to annuity into PVAF bracket R and N. Annuity PV is divided by PVAF. PV is equal to 5 lakhs. So PVAF 12%. And for 12% and 5 years is equal to 3,605. So 5 lakh is divided by 3,605, which gives the answer as 1,38,696.25. Rule of 72. In finance, the rule of 72 is the formula that estimates the amount of time it takes for an investment to double in value, earning a fixed annual rate of return. The rule is a shortcut calculation to determine the amount of time for an investment to double in value. The simple calculation is dividing 72 by the annual interest rate. It depends upon the rate of interest. If rate of interest is 8%, the time required to double the amount is 72 divided by 8 is equal to 9 years. It will take approximately 9 years to double the amount. Financial goals, chapter number 5. Introduction. Most people want to handle their finances so they get full satisfaction from each money spent. Typical financial goals include such things as a new car, a larger home, advanced career training, extended travel, and self-sufficiency during working and retirement years. To achieve these and other goals, people need to identify and set priorities. However, if you don't set your financial goals, you'll probably be left wondering where all your money went. In this chapter, we will study about the financial goals, their needs, types, and importance in our life. Meaning of financial goal. Financial goals are targets usually driven by specific future financial needs. Some financial goals we might set as an individual include saving for a comfortable retirement, saving to send our children to college, or managing our finances to enable a home purchase. Financial goals are the personal, big picture of objectives you set off for how you will save and spend money. They can be things you hope to achieve in the short term or the further down the road. Either way, it's often easier to reach your goals if you identify them in advance. To achieve financial goals, people need to identify and set priorities. Financial and personal satisfactions are the result of an organized process that is commonly referred to as personal money management or personal financial planning. Some financial goals we might set as an individual could include saving for a comfortable retirement, saving to send our children to college, or managing our finances to enable a home purchase. Financial goals are where you want to be financially in the next 5, 10 and 20 years, or even next year. Example of financial goals include paying off debt, saving for retirement, building an emergency fund, buying a home, saving for a vacation, starting a business, feeling financially secure. Why financial goals are needed? Having financial goals can help you shape your future by influencing the actions you take today. For example, say your goal is to pay off a colossal credit card bill. You might cut back on takeout dinners and use the money you save to pay extra payments instead. Without establishing that goal, you are more likely to continue spending as usual while your debt piles up. Like all expenses, financial goals should be included in your budget. That way you can take concrete steps towards reaching them while having room for other costs as well. Types of financial goals. First, short-term financial goals. Short-term financial goals take under 1 year to achieve. Example, this may include taking a vacation, buying a new refrigerator, or paying off a specific debt. Second, middle-term financial goal. Middle-term financial goals cannot be achieved right away but shouldn't take too many years to accomplish. Examples may include purchasing a car, finishing a degree or certification, or paying off your debt. Third, long-term financial goal. Long-term financial goals over 5 years may take us several years to accomplish and as a result require longer commitments and often more money. Example might include buying a home, saving for a child's college education, or a comfortable retirement. Financial goals you must achieve before your 40s. For instance, retirement planning may not be a priority in your 20s, but when you near your 40s, you want to invest to secure your golden years. Just like other life stages, your 40s is a critical phase in your life. This is normally the time by which people are nearing the peak of their careers, having a family to support, and need to balance complex obligations like funding their children's education and paying off a home loan. Each stage of life is different, and so are its financial goals. Here are few financial goals that you must achieve before you turn 40. Securing a home for yourself, building an emergency fund, get yourself life and health insurance, retirement planning, plan for your children's education. Example of personal goals. There are some examples of personal goals. Classify them into short term, intermediate, and long term. Possible goals could be minimize your debt, pay off college loans, build an emergency fund. Develop financial goal chart. Developing a financial goal chart is a good way to begin this process. Here are 5 steps you should follow in order to set up your goal chart. First, write down one personal financial goal. It should be specific, measurable, action-oriented, realistic, and it should have a timeline. Decide if your goal is short-term, mid-term, or long-term and create a timeline for that goal. This may change at any time based on your situation. Determine how much money you need to save to reach your goal and separate that money by the month and or year. Think of all ways you can reach that goal. Include saving, cutting expenses, earning extra money, or finding additional resources. Decide what is the best combination of ways to reach your goal and write them down. Steps to set financial goal. First, be clear about the objectives. Any financial goal without a clear objective, nothing more than a pipe dream, and this could not be more true for financial matters. Once the objective is clear, put a monetary value to that objective and the time frame. The important point of that step of goal setting is to list all the objectives, however small they may be, that you foresee in the future, and put a value to it. Second, keep them realistic. It's important that you keep your goals realistic in nature, for it will help you to stay the courses and keep you motivated throughout the journey. Third, account for inflation. You should account for inflation whenever you're putting a monetary value to a financial objective that is far away in the future. For example, if one of your financial goal is your son's college education, which is like 15 years hence, then inflation would increase the monetary burden by more than 50%. If inflation is mere 3%, so always account for inflation. Fourth, short-term versus long-term. As a rule of thumb, any financial goal which is due in next 3 years should be termed as short-term goal. Any longer duration goals are to be classified as long-term goals. This bifurcation of goals into short-term versus long-term will help in choosing this right investment instrument to achieve them. Fifth, financial goals are yours, not inspired by others. The journey of setting financial goals is in an individualistic affair. That is, your goals are your own goals and determined by your own want to achieve them. A lot of times we get on the bandwagon of goal setting only to realize later on that it was not meant for us. It is important that your goals are actually your goals and not inspired by somebody else. Take a hard look at this step. At all goals you will have set for above this step, you will be on way to achieve them. How financial goals can be achieved? Smart strategy. The word SMART stands for specific, measurable, achievable, relevant and timely. The list of goals that satisfies this criteria is a SMART spectrum. Any goal which you can bring in this list is well within your potential to achieve them. For example, saving for a motorbike is hard to measure. How will you know if you're making progress to have achieved it? On the other hand, saving 50,000 rupees for a 100cc motorbike within 10 months is smart. It's specific, you know exactly what you're saving for, it's measurable, you know how much you will need, it's achievable and realistic. You can break the total amount needed into smaller steps, saving 5,000 rupees a month, which is easier to do, and it's time bound. You have set a deadline of 10 months. Important to see short, medium and long term financial goals. Let's get smart. For example, if you want to buy a house, say I want to buy a 3 BHK flat in ECR worth of 2 crores in 7 years. Be specific about the financial needs and a time need and the other goal influencing the factor like region, rules and regulations, economy status, etc. Measurable. Give your financial goals measurable number and values. What kind of flat? 3 BHK. What should be the word? 2 crores. In how many years? 7 years. Achievable. Set achievable financial goals. For a house worth of 2 crores in 7 years, you will need to save nothing less than 25 lakhs per year, assuming your savings will give a 12% return. If this is possible for you, you are good to go. You have an achievable financial goal. Relevant. On the simplest yet vital ways, make your financial goals relevant to your life and dreams. If you are going to settle in Bangalore for the rest of your life, would a 3 BHK in ACR Chennai make any sense? Timely. You probably won't need a house now. You can take some time to achieve it since it is not going to affect the achievement of your other financial goals. But you cannot afford to lose time in your child's education. You should plan for that financial goal before other financial goals. There are few questions one can ask himself to achieve his goal. What do I want? What are my priorities? When do I want it? What will it cost? How can I make savings easier? There are 8 strategies by applying these financial goals can be achieved easily. Obtain financial goals. Plan how to spend your money. Spend wisely. Save on a regular basis. Borrow wisely. Invest to increase current income for long-term growth. Manage risk. Plan for retirement. Significance of financial goals. Reason 1. You need to know where you're going. What are you trying to achieve? How will you define success? Setting financial goals will help you answer both of the questions. Reason 2. Setting financial goal dictates how much you need to save. How much do you need in savings and investment to realize your financial goals? By setting financial goals, you're quantifying your ambitions, putting a number on them. Reason 3. Different financial goals require different strategies. When you have decided your financial goals, you can work on the strategies which are right for you. Reason 4. It helps shape your career choices. When you know what your financial goals are, your career planning and your financial planning can complement each other. Reason 5. Setting financial goals help you stay focused. This will help you stick to your guns when you're tempted to splurge on something you don't need and remind why you're working on the extras. Reason 6. You can find the right tools to help. Setting financial goals will enable you to critically evaluate which tools can help you on your way so you can buy only those which are most useful to you. Reason 7. Setting financial goal creates a sense of achievement. Setting financial goals is the very first step and it takes both thought and discipline. Summary. In conclusion, it can be said that if finance is means for everything, financial goal is the end for everything. Without financial goal, no individual can achieve whatever he or she wants to achieve. So one must start planning financial goals from a younger age. Even parents should encourage their children to think about financial goals. Chapter number 6, financial planning. Introduction. You all have many financial goals in your mind, like buying a car or the latest smartphone or wealth accumulation. You need to have an adequate amount of money to fulfill your goals and desires. Whether you have a lot of money or not enough, you will need personal financial planning. If you have enough money, planning can help you spend and invest it wisely. If your income seems inadequate, taking steps to plan your financial activities will lead to an improved lifestyle. More importantly, you need to have money at the right point in time. Everyone, including recent college graduates, single professionals, young married couples, single parents, mid-career married breadwinners and senior corporate executive need to develop a personal finance plan. Knowing what you need to accomplish financially and how you intend to do it gives you an edge over someone who merely reacts to financial events as they unfold. For example, if you want to build up a corpus of 10 lakh for your daughter's college education through investment, you need to grow this amount by the time she turns 18, not a year later. This is why financial planning becomes essential. The financial planning not only just it's not just about increasing savings and reducing the expenses. Financial planning is a lot more than that. This includes achieving your future goals. In this chapter, we are discussing about the financial planning and the steps in the financial planning process. Financial planning. Financial planning is the process of meeting your goals through the proper management of your finance, or we can say the financial planning is the planning which deals with money. A financial plan acts as a guide as you go through life's journey. Essentially, it helps you to be in control of your income, expenses, and investments such that you can manage your money and achieve your goals. You need to have an adequate amount of money to fulfill your goals and desires. More importantly, you need to have money at the right point in time. Financial planning normally restricts to the financial aspect. Financial planning is done both by the individuals for their own future life and business people to know about the funds required for a future period and the sources of funds available. Whether an individual is in college getting ready to graduate, or at the peak of his or her career, or close to retirement, everyone needs to think about their financial future. Everyone makes financial decisions every day. Few people consider how to make better decisions to achieve a higher level of personal economic satisfaction. Financial planning is a step-by-step approach to meet one's life. Financial plan can help you to balance today's need with your goals for the future, make the best use of your financial resource, save the money you need to achieve your goal, adapt to change in your circumstances and needs, protect what is most important to you, prepare for retirement, leave something for your family, manage your taxes, live your life with a sense of direction and security. Planning means that you try to choose the future you want instead of falling into a future you did not choose. Also, if you have a plan, you can adjust it when changes occur in your life because you know you are taking steps to manage your future. You will save more and worry less. Begin your financial planning by answering 3 key questions. Where am I now? Where do I want to go? How do I get from where here to there? Today, time is with you, but you'll be able to continue the same throughout your life. Will your income be the same forever? Will you be able to live on your own terms even after you retire? Answer these questions and then think of financial planning. Why should we do financial planning? Financial planning enables us to plan in advance our likely expenses, keeping in mind our level of income. Thus, it helps in 2 ways. 1, we can save regularly a portion of our income and meeting future needs. And 2, we can cut down expenses on non-essential items with a view to save them for future needs. So we should start financial planning today so that we are in better position to pay off our debt and build savings to buy a house or finance higher education with our own money. Attain your goals with financial planning. How to do financial planning? Assess current financial position. Where are we today? Identify our financial needs. Estimate the cost of each item and the date we want to achieve it. Calculate how much we need to save each week or month. Maintain a financial diary. Write down weekly, monthly incomes and expenses. Curb expenses. Spend sensibly. Review savings regularly, whether it is as per the plan. If not, look at expenses for opportunity areas to cut back spending and increase savings. Deposit savings in a bank account. Determine the amount saved at the end of each week or the month. Why to maintain a financial diary? A financial diary helps us to do financial planning. We would know how much money is being spent on essential and non-essential items during a given month. This helps us to identify the items on which the expenses can be avoided or reduced. Once we know it, we can regulate these expenses. We can save this money and break the cycle of poverty. Always think twice before spending. For example, our monthly income is 5,000. By maintaining a financial diary, we have come to know our expenses, that is food, shelter and clothes, 2,000, education of children 1,000, rent 700 and sickness 300, and expenses and wants like festival, pilgrimage 500, expenses of drinks, gambling, etc. 500. We can reduce expenses on festivals, pilgrimage from 500 to 200 and avoid expenses of 500 on drinks, gambling. The excess of 800 can now be saved. Thus, by maintaining a financial diary, we have saved money. Without the diary, we will just spend all the money in our hand. Steps in financial process. First, understand your current financial situation. In the first step of financial planning process, you will determine your current financial situation with regard to income, saving, living expenses and debts. Second, write down your financial goals. Ask yourself, what are the different financial goals I wish to achieve in life? Write them down on a piece of paper. Don't hesitate to put down any goal because no goal is too big or too small. However, make sure that your goals are specific. For instance, here are some achievable goals. I want to purchase an SUV worth 13 lakh in the next 18 months, or I want to buy an apartment worth 80 lakh in the next 5 years. Third, look at different investment options. There are numerous investment options available to investors. You can invest in equity, debt, bond, mutual funds and derivatives. In the mutual fund market alone, you can choose from nearly 2,000 schemes. Different investment venues help investors to achieve different goals. For example, equity funds are suitable for long-term goals like retirement planning, child education, etc. If you're interested in a relatively steady income and you are risk averse, you may want to invest in debt mutual funds, equity linked savings scheme, ELS Funds are good to save tax when it comes to investing, and many financial experts have highlighted the importance of mutual funds. Investing in these funds consistently over a longer period can help you achieve your dreams and goals. Fourth, implement the right plan. You need to select the right investment option based on factors such as your goals, your age, your risk appetite, and investment amount. If you're unsure of the funds you need to select for your portfolio, you can avail the services of a financial advisor. Fifth, monitor your financial plan regularly. The financial planning process does not end once you invest your money. You also need to monitor how the funds are performing regularly. If they do not perform, you may need to replace them with the better performing funds. You also need to follow your plan because as you grow older, your goals and dreams evolve. For instance, your financial priorities may change after the birth of a child. Now you need to accommodate the expenses and objectives of a new member in your family. Sixth, reevaluate and revise your plan. Financial planning is a dynamic process that does not end when you take a particular action. You need to regularly assess your financial decisions. Changing personal, social, and economic factors may require more frequent assessment. When life events after your financial needs, this financial planning process will provide a vehicle for adapting to those changes. Regularly reviewing the decision-making process will help you make priority adjustments that will bring your financial goals and activities in line with your current life situation. Preparing a financial plan, practical considerations. Each individual or family is different, so will have their own financial needs. One cannot expect to have same financial plan as another even if two people are earning the same salary. This is because financial situation and risk-taking ability are different. Suppose a person already has to pay a housing loan installment, EMI, and take care of other personal responsibilities, then his risk-taking ability would be much lower than a person who does not have to repay a loan. How exactly do you go about preparing a financial plan? Assess your finances, make a list of your bank account, investment, fixed deposit, mutual fund, shares, etc. What are your expenses per month? How much do you spend on rents or installments, your kids' education, monthly kitchen expenses, and so on? You'll be able to understand where you are with respect to your income, expenses, and savings. Now, the next step would be to list down your goals, which would be short term, medium term, or long term. Your short term goals could be buying a car or going on a vacation. Let us presume in the next 5 years. Your medium term goals could be your child's education, buying a house, or setting up your own business. This could be planned for maybe 10 to 15 years. For long term goals, you could plan for 20 years after and think of retirement, clearing all loans, keeping some money aside for emergency. These are three parameters which you have to consider: time, money you can save, and the rate of return. Based on your goals and your risk-taking ability, you can diversify your money among different asset categories such as share, bonds, fixed deposit, and cash. Now we will to start with chapter 10, mutual funds. Learning outcomes. After studying this chapter, you should be able to understand definition of mutual funds, different type of mutual fund schemes, systematic investment plan, systematic withdrawal plan. Now, we'll start with the introduction. A mutual fund is a financial intermediary that pools the savings of investors for collective investment in a diversified portfolio of securities, including equity, bonds, debentures, and other instruments issued by a business or government undertaking. Small investors who are unable to participate in the capital market can access the stock market through medium of mutual funds, which can manage their funds for maximizing return. The investment may be diversified to spread risk or to ensure a good return, dividend or capital gain or both to the investors. Thus, a mutual fund is a pool of funds contributed by individual investors having common investment preferences. All the returns from such investment, both in terms of dividends and capital appreciation, the net of various incidental expenses accrues to the investors. A mutual fund provides many financial and non-financial benefits to the investors. Like shares, all mutual funds provide returns in the form of dividends and capital appreciation, even bonus issues. Next topic is net asset value. Net asset value is the market value of the assets minus liabilities on the day of evaluation. In other words, it is the amount
the shareholders will collectively get if the fund is dissolved or liquidated. The net asset value of a unit of a mutual fund is the net asset value of the fund divided by the number of outstanding units. Now, different types of mutual fund schemes. Open-ended scheme. In the case of open-ended schemes, the mutual fund continuously offers to sell and repurchase units at NAV. Open-ended funds do not have to be listed on the stock to exchange and can offer repurchases soon after allotment. These do not have a fixed maturity. Investors can enter and exit the scheme during the life of the fund. There is no fixed redemption period in open-ended schemes, which can be terminated whenever the need arises. The key feature is liquidity. The majority of mutual funds, 59% approximately, are open funds. Close-ended schemes with a stipulated maturity period ranging from 2 to 15 years are called close-ended schemes. Investors can invest directly in the scheme at the time of initial issue, and thereafter they can buy or sell the units of the scheme on the stock exchanges where they are listed. The market price at the stock exchange could vary from the scheme's NAV on account of the demand and supply situation, unit holders' expectations, and other market factors. One of the characteristics of the closed-ended schemes is that they are generally traded at a discount to NAV, but closer to maturity, the discount narrows. The NAV of the closed-ended scheme is generally disclosed every week. So we are moving on to the next page. There is a figure, and then we have the topic of interval schemes. These combine the features of open-ended and closed-ended schemes. They may be traded on the stock exchange or be open for sale or redemption during predetermined intervals at NAV-related prices. Growth schemes. The objective of a growth fund is to provide capital appreciation over the medium to long term. These schemes normally invest most of their funds in equities and are willing to bear short-term declines in value for possible future appreciation. There is no guarantee or assurance of returns. These schemes are usually close-ended and listed on stock exchanges. These schemes are not for investors seeking regular income or needing their money back in the short term. Ideal for investors in the prime earning years or investors seeking growth over the long term. Income schemes. The aim of the income scheme is to provide regular and steady income to investors. Moving on to the next page. These schemes generally invest in fixed income securities such as bonds and corporate debentures. Capital appreciation in such schemes may be limited. The return as well as the risk is lower in income funds as compared to growth funds ideal for retired. So it is ideal for retired people and others who need capital stability and regular income, and for investors who need some income to supplement their earnings. Balanced schemes. The aim of a balanced fund is to provide both growth and income by periodically distributing a part of the income and capital gains they earn. They invest in shares and fixed income securities in the proportion indicated in their offer documents. In a rising stock market, the NAV of these schemes may not usually keep pace or fall equally when the market falls. The portfolio of such funds usually comprises companies with good profit and dividend records. Their risk exposure is moderate and they offer a reasonable rate of return. The NAVs of such funds are likely to be less volatile than pure equity funds, ideal for investors looking for a combination of income and moderate growth. Now we have a box which has a case study or a case, you can say. So it is Rahul, aged 35, is the regional marketing head of a famous company. His only immediate family is his wife and twins, aged 3. Ramesh is in the modern class of investors who know how important savings and emergency funds are. Since he is an aggressive, unconventional investor, he prefers to invest in equity funds like SIPs. His needs are growing. The present net salary Ramesh is rupees 1 lakh. Expenses amount household expenses rupees 25,000, personal expenses 10,000, insurance premiums 5,000, miscellaneous 10,000. Ramesh spends 50,000 of his 1 lakh salary on household expenses, personal expenses, insurance premiums, and other miscellaneous expenses. The present assets of Rahul include fixed deposits, which are 20 lakh, EPF 10 lakh, insurance value 4 lakh 70,000, property 27 lakhs. Findings. Ramesh Mehta's fixed deposits are enough to cover an emergency, thus, he already has built a good emergency fund. Naresh is covered through employer group insurance policy of 5 lakh. Besides this, he's paying a monthly insurance premium which provides term plan cover of 50 lakh. He also has 2 endowment policies, thus, he is adequately covered. He should stop endowment policy which matures in 2 years. The yield on endowment policy is much lower, and it makes sense to invest the amount in equity and debt funds, which can provide higher returns. He can also consider surrendering his endowment policies and increase term cover. Rahul has no debt. Now we have money market schemes. The main aim of these schemes is to provide easy liquidity, preservation of capital, and moderate income. These schemes generally invest in safer short-term instruments such as treasury bills, certificates of deposit, commercial paper, and interbank call money. Returns on these schemes may fluctuate depending on the interest rates prevailing in the market. Ideal for corporate and individual investors as a means to park their surplus funds for short periods or awaiting a more favorable investment alternative. Moving on to the next page, other schemes, tax saving schemes. These schemes offer tax rebates to investors under tax laws as prescribed from time to time. This is made possible because government offers tax incentives for investment in specified avenues. For example, equity-linked saving schemes, ELSS, and pension schemes. Pension schemes. A pension scheme is a type of long-term savings plan, and it's a tax-efficient way to save during your working life. You save some of your income regularly during your working life. This gives you an income in later life when you want to work less or retire. That's the point of pension security when you're older. Systematic investment plan is next topic. SIP. Systematic investment plan, commonly referred to as an SIP, allows you to regularly invest a fixed sum in your favorite mutual fund schemes. In SIP, a fixed amount is deducted from your savings account every month and directed towards mutual funds you choose to invest in. A systematic investment plan is a process of investment offered by different mutual funds in which the investors can make a periodic investment of a small amount instead of a lump sum. So there is a box here which contains a case. I have started a SIP of an year 10,000 per month for the next 30 years. In this case, I'm assuming that a well-diversified mutual fund scheme will deliver 12% per year. We have schemes in India that have done almost double of that for a decade, but we should not be over-optimistic and stick to 12% for this and also for other scenarios. So after investing 10k monthly for 30 years, the corpus will finally reach an amount of INR 3.24 crores. Now moving on with the reading. The investment can be made weekly, monthly, or quarterly. SIP helps to grow money through compounding interest, ensuring higher returns of maturity. So you can say that SIP is a smart or rather hassle-free mode of investing in mutual funds where you are allowed to contribute a predetermined sum of money. It is flexible in nature, and thus investors can choose to decrease or increase the amount of investment or stop investing in the plan whenever they want. SIP is the safest and best choice for investment beginners and those who are not well versed in the mechanism of the financial market. Now there is a box which has the heading Why to Invest in SIP. So the reasons given here are discipline a financial decision, start with as low as 500, no charges to invest in SIP, compounding interest benefits, help to manage market volatility. Moving on to the next page. SIP is unsuitable for an investor who wants to tap the long-term potential of equities and is willing to invest regularly. Investors who want to invest a good amount but are unable to pile up a big amount in one shot would also find SIP to be worthwhile. So SIP is not a mutual fund, rather it is a method of investing in a mutual fund. It is a simple strategy designed to help investors to accumulate wealth in a disciplined manner over long term to avoid the following benefits. Number one, cost averaging. An investor invests a fixed amount irrespective of NAV in SIP, so he gets fewer units when NAV is higher. It can smoothen out the market's ups and downs and reduce the risk of investment when markets are more volatile. SIP helps reducing the average cost per unit and helps an investor to take advantage of market fluctuations and thereby reduces the risk. Number two, power of compounding. An investor has two options to invest. First, to invest regularly as and when surplus funds are available, and second, to accumulate these smaller savings and to invest at yearly interval. For example, he may invest 1,000 per month for a period of 5 years, and second, he may invest 12,000 per year for a period of 5 years. In both cases, he investment would be 60,000, but the accumulation amount when the interest rate is 10% in first case is 78,082, and in second case the first option is an example of SIP. Number three, disciplined investing. SIP offers a disciplined way of investing a portion of income of an investor. It helps an investor to eliminate the fear that he may buy mutual fund units at its peak just before the markets head into a slump. Power of starting early. The earlier one starts saving and investing regularly, the easier it is to achieve your goals. The graph below shows the impact of beginning to invest rupees 5,000 monthly at various stages of life till the age of 60 years, assuming a return of 12% per annum. So there is a figure given with the graph. So if we start SIP at age 25, as per the illustration shown, a corpus of approximately rupees 2.76 crores can be generated in retirement. If you would have waited 5 years and started SIP at age 30, a corpus of approximately 1.5 crore would have been available to you at retirement. That is a difference of 1.21 crore, which is the cost of dealing starting SIP. Now moving on to the next page. The next topic is systematic withdrawal plan. Systematic withdrawal plan, or SWP, works in opposite way to systematic investment plan. A systematic investment plan allows an investor to invest a fixed amount at predetermined intervals, and a systematic withdrawal plan is a facility which allows an investor to withdraw a fixed amount at predetermined intervals. The investor can choose the amount, the frequency, and the duration of SWP according to his needs. The periodic intervals could be monthly, quarterly, half-yearly, or annually as per investor's requirement. With every withdrawal, the value of your investment in the fund is reduced with the market value of the units you have withdrawn at the withdrawal, as the withdrawal happens at the day's NAV. How does a systematic withdrawal plan work? Let us understand with the help of an example. Suppose Mr. X purchased 1000 units of a mutual fund scheme for rupees 1 lakh in January 2018 and withdrew 1000 rupees 1000 per month for 4 months starting February 2018 via systematic withdrawal plan. Now there is a table given, then it's written. So by the end of May, Mr. X has withdrawn rupees 40,000 total via SWP and owns an investment worth rupees 65,296. Now advantage. Number one, disciplined investing. Systematically withdrawal plan automatically redeems some mutual funds units every month to meet the monthly expenses regardless of market levels. It thus protects you from withdrawing large amounts due to panic or fear during times of market corrections. It also withdraws money even when the markets are registering new highs and thus protects you from the impulse to invest more money during boom periods. Number two, rupee cost averaging. SWPs help investors benefit when they withdraw their investments due to rupee cost averaging. Rupee cost averaging gives investors the average NAV of a mutual fund over several months or years rather than making him dependent on NAV at a single point of time. Fixed income SWP helps to get a fixed periodic amount which can help to get a steady income in his or her retirement years or managing his or her child's educational expenses. Number four, tax efficiency. When we withdraw through an SWP, it is considered to be a combination of capital and income. Tax is only payable on the income component, not the capital component. For example, assume that Mr. X has invested 1 lakh in a mutual fund and this grows to rupees 1.1 lakh, that is 10% growth. He withdraws rupees 10,000 from his mutual fund at the end of each year. Only 10% of his withdrawal, that is 1,000, is considered as income, and the balance 9,000 is considered as capital withdrawal. On the other hand, if you had invested in a bank FD and got 10,000 interest on a principal of 1 lakh, the entire 10,000 would be considered as income and would be taxable. So we are on the next page. So the next topic is regular and direct mutual fund schemes. Regular and direct mutual fund plans are just the two options of a mutual fund scheme run by the same fund managers who invest in the same stock and bonds. The only difference between direct versus regular funds is that in the case of a regular plan, your AMC or mutual fund house does not pay a commission to your broker as distribution expenses or transaction fee out of investment. Whereas in a case of direct plan, no such commission is paid. The absence of commission in the direct plans leads to a higher rate of return than regular plans. Thus, it is always wiser to invest in direct mutual fund plans as long as you have a clear understanding of how mutual funds work. Next topic is, and the last topic is, tax implications in mutual funds. There are two types of earning from a mutual fund investment: dividend and capital gains, and both are taxed differently. While the mutual funds house deducts dividend distribution tax, which is DDT, from the dividend paid to you at 10%, capital gains tax is taxable in the hands of the investor. Now we have a table, and then there are some review questions. Question number one: mutual fund is the safest option of investment from Indian point of view. Does it really means, or it's a myth? Then question number 2, what is SIP? Explain the benefit of investing through SIP. And question number 3, why mutual fund is known as indirect investment. And this is the end of the reading.